now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. Today, you are joining me for our Back to Basics series. In this video, we're going to be talking about what is your credit score, why is it important, and how to increase it. A good credit score can unlock a myriad of opportunities. It paves the way for lower interest rates on products, easier approval for essential loans like mortgages or car loans, and it also speaks volumes about your reliability to lenders. Your credit score essentially showcases your financial trustworthiness, signaling to lenders the potential risk in lending you money or extending a line of credit. Naturally, a higher score indicates lower risk, making approval more likely. So, let's break this down further. Your credit score is broken up into 5 key components. The first component is the total amount of debt owed. This makes up 30% of your credit score. This can be improved by paying down the balances of your loans and credit cards. The amount owed affects your debt-to-income ratio and therefore impacts your chances of being approved for more credit. To calculate your debt-to-income ratio, you want to add up your monthly bills, which may include monthly rent, a house payment, or other debts. Then you divide that by your gross monthly income, which is your income before taxes. The result is your DTI, which will come in the form of a percentage. The lower the DTI, the less risky you are to lenders. The more debts you have, the more income you need to reduce the DTI. Banks often need 2 years of consistency from any reported income, so don't think that you're just going to pick up DoorDash for some extra income and that will improve your odds. Also, under the table work does not count either. This component is also affected by your credit card utilization rate. The more of your available credit you use, the more this impacts your score. You typically don't want to use more than 30% of the credit available to you, but I wouldn't use more than 10 to 15% personally. The second component is the amount of new credit. This makes up 10% of your total score. New credit is how many new credit accounts you are opening. If the bank sees that you are opening too many accounts, they will likely view you as risky and that you are opening so many accounts for some sketchy reason. This also impacts your length of credit history. So do not open too many accounts. Stick with a few and be a good steward of them. You can also see hard inquiries about new credit accounts and how that affects your score. The third component is the length of credit history, which makes up 15% of your total score. Your length of credit history shows how loyal you have been to your current creditors. It shows that you haven't defaulted on your creditors, and it shows how long you have been in the game. The longer track record, the better your score. This is based on the average amount of time all of your accounts have been open. Now, as you may have noticed, opening new credit accounts reduces the length of credit history, which is negative for your score. The fourth component is your mix of credit, which is a mix between revolving credit and fixed credit. This makes up 10% of your total score. Your credit mix is based off how many fixed credit accounts you have and revolving credit accounts you have. Fixed credit is typically a loan. When you make your payment, it goes towards interest and principal, and you cannot access that money again. Revolving credit is usually a credit card, a HELOC, or some other type of credit account that allows you to make the payment towards the principal and interest, but you can access the money again. Too much revolving credit can be seen as risky in this component. The fifth and last component is your payment history. This component makes up 35% of your credit score. This one is pretty plain and simple. If you do not make your payments on time, it can and will affect your credit score. Lenders want to reduce risk, and if you do not make your payments on time, you are seen as risky, which will show in your credit history and your score. I hope that all of this has been helpful for you understanding how credit scores work and how to increase it. Please hit the like button and consider subscribing if you enjoy this type of content. So for now, I see you all in the next video.